I am Reed. I am 27, just an average dude. I've made tons of money mistakes in my 20s, and now I want to share everything I've learned to help you take control of your finances and your life. All right, so let me start with something real. I was sitting on my couch the other day scrolling through my phone, and I saw this headline about the national debt hitting $39 trillion. And I just sat there for a second and thought, man, that number is so big I can't even wrap my head around it. Like 39 trillion. With a T, that is not just a lot of zeros on a screen, that is real money that we as a country owe. And on May 15th, the United States got a new leader at the Federal Reserve Bank. His name is Kevin Warsh. And now everybody is asking the same question. Is he going to cut interest rates like Trump wants, or is he going to keep them high? Because inflation is still a problem, and I get why people are asking that. But here is the thing. Instead of trying to predict what is going to happen next like some kind of fortune teller, I think it is way smarter to look at history, because we have seen this movie before, not the exact same movie, but a similar one. And history doesn't repeat itself exactly, but it does rhyme. The last time we saw the Fed dealing with a debt problem like this, certain assets went up by more than 1,600%. So in this video, I want to walk you through what happened in the past, which assets won, and how you can use that information to be smart with your own money. Not to chase some crazy risky bet, but to put yourself in a better position no matter what happens. Let me take you back to my own story real quick, because I think it gives you context on where I am coming from. I grew up in a regular middle-class family. My parents worked hard, they did the best they could. But nobody taught me about money. Nobody sat me down and said, hey, here's how you budget, here's how you save, here's how you invest. So when I got into my early 20s, I was a complete mess financially. I was spending money I didn't have on stuff I didn't need. I had credit card debt. I was paying minimum payments every month, watching the interest pile up. I was living paycheck to paycheck, and I had no savings, no emergency fund, no plan for the future. I was just winging it, and honestly, I was miserable. I remember lying in bed at night, feeling this knot in my stomach because I knew I was messing up. But I didn't know how to stop. Sound familiar? If it does, you are not alone. A lot of people in their 20s are in the exact same boat. The good news is I turned it around. I started learning. I read books. I watched videos. I started paying attention to my spending. I got out of debt. I built an emergency fund. I started investing. Nothing crazy, just steady, consistent, boring stuff. And now I want to share what I've learned with you. Not because I am some expert or guru, but because I am just a regular guy who figured some things out, and I want to help you do the same. So let's talk about the Fed. The Federal Reserve Bank is basically the central bank of the United States. They control interest rates, and they have a huge influence on the economy. When they raise rates, borrowing money gets more expensive. When they cut rates, borrowing gets cheaper. Simple enough, right? But here's where it gets interesting. Over the last 50 years, we have seen 3 major Fed cycles, and in each one, some people got rich while most people just watched it happen. I want to break those down for you so you can see the pattern. First cycle, late 1970 stagflation crisis. Inflation was through the roof, prices were going up fast, and the economy was struggling at the same time. So the Fed did what they had to do. They raised interest rates aggressively. I am talking up to about 20%. That is insane when you think about it. Can you imagine paying 20% interest on a loan today? Well, back then, that was reality. And over the next 5 years, cumulative inflation was around 52%. That means the price of everything basically went up by half. Meanwhile, wages over those same 5 years grew by only about 36%. So the average person was making more on paper, but they could actually buy less stuff. They became poor without even realizing it because the money in their paycheck didn't go as far. Now, what happened to assets over that same period? The stock market grew by about 54%, so it beat inflation, but not by much. Real estate prices did not keep up with inflation. Gold prices actually stayed flat after a wild ride up and then back down, and Bitcoin did not exist because this was the 70s. So who got rich in that cycle? It was the people holding cash and bonds. Why? Because with interest rates at 20%, you could earn 15% a year just by lending your money to the government. You could beat inflation by holding long-term bonds while rates kept going up. The cash holders and the bond holders were the winners. Now, I want to pause here and say something from my own experience. When I was in my early 20s, I had zero interest in bonds. I thought bonds were for old people and retirees, but looking back, I realized that having a safe place to park your money when interest rates are high is actually a smart move. It is not flashy, it is not exciting, but it works. And that is the kind of stuff I wish somebody had explained to me earlier. Second cycle, 2008. The great financial crisis, the housing market collapsed. Banks were failing, the whole economy was on the verge of falling apart, so the Fed did the opposite this time. They cut interest rates to near zero, and they printed a ton of money to stimulate the economy. Over the next 5 years, cumulative inflation was around 11% according to government numbers. And again, wages did not keep up. Median income grew by a little under 7%, so once again, the average person who relied on a salary became poorer. But look at what happened to assets. The stock market, specifically the S&P 500, grew by about 200%. Real estate prices grew by around 50%. Gold prices grew by about 70%. Bitcoin still did not exist. So the winners this time were not the cash holders, they were not the bond holders, they were the asset owners. People who owned stocks became incredibly wealthy. Real estate investors got rich, gold owners did well, and the person just working for a paycheck got left behind. This is a huge lesson. When the Fed cuts rates and prints money, the money has to go somewhere. It flows into assets, and if you own those assets, you benefit. If you don't own them, well, you just watch everybody else get ahead while you fall further behind. Third cycle 2020, the pandemic, the economy shut down almost overnight. The Fed cut rates to the lowest levels we have seen in modern history. They printed money like crazy. And we all remember what happened next. Between 2020 and 2025, cumulative inflation was around 25% according to the government. But let's be real, a lot of people felt way more than that. Everything got more expensive, groceries, gas, rent, everything. Meanwhile, median income in America rose by about 20%. So again, wages could not keep up, the average person got poorer. But assets, they exploded. The S&P 500 boomed by around 160%. Real estate prices went up by about 45%. Gold prices rose by around 125%. And Bitcoin shot up by 1,600%. Think about that. 1,600%. That is life-changing money for anyone who had the foresight to put even a small amount in before the run. Now, I want to talk about Bitcoin specifically for a second, because when interest rates go down and money gets printed, there's just more cash floating around. Institutions and investment banks can borrow money for 1, 2, 3, or 4%, so they only need to get a 5, 6, 7, or 8% return for it to be worth it. That means they start looking for places to put that money, and that is when speculative investments take off. That is when venture capital firms pour money into risky startups. That is when valuations go crazy, and that is part of what fueled Bitcoin's rise. Not to mention the fact that a lot of people saw Bitcoin as a hedge against the dollar losing value. So all that new money flowed in, and Bitcoin hit new all-time highs, going from around $7,000 a coin in early 2020 to well over $100,000 at its peak. Now here is the pattern I want you to notice. In every single one of these cycles, wages did not keep up with inflation. The average person working a regular job became poorer in real terms, but asset owners got wealthier every single time. Whether the Fed was raising rates or cutting rates, stocks and real estate did well over the long run. And when the Fed cut rates, speculative assets really took off. So the question for us today is simple. What happens next? We are in 2026. Now we have a new Fed chair, Kevin Warsh, who started on May 15th. President Trump appointed him, and Trump has been very clear that he wants lower interest rates. He said he would not appoint anybody who did not want lower rates. But Kevin Warsh is saying something different. He is saying inflation is still a problem, and he is not sure about cutting rates. So we have this tension. On one hand, we have the president pushing for lower rates to stimulate the economy. On the other hand, we have the new Fed chair who seems cautious because inflation is still elevated. And on top of all that, we have a $39 trillion national debt. Our debt to GDP ratio is about 122%. That means the government owes more than the entire economy produces in a year. The last time we saw numbers anywhere near that high was after World War II in the 1940s. So we are in uncharted territory for most of us alive today. Let me put this in perspective in a way that makes sense. Imagine you want to buy a house, you go to the bank and you ask for a loan. The bank is probably going to ask you to put down a down payment of maybe 5%, 10%, or 20%. The reason why is because the bank does not want to give you a loan for the full value of the house. They want you to have some skin in the game, so they finance 80%. And you put down 20%, that is an 80% loan to value mortgage. Now imagine you go to the bank and you say, hey, I want to borrow 122% of the value of the house. The bank would laugh you out of the building, but that is exactly where the United States government is right now. We have a 122% debt to GDP ratio. We are underwater on our national debt, and that is a massive problem. So the Fed has to make a decision. Do they cut rates to try to boost the economy and deal with the debt, or do they keep rates high to fight inflation? And here is the tough part. They cannot do both. If they cut rates, that stimulates the economy, but it also makes inflation worse. If they raise rates, that fights inflation, but it hurts the economy and makes the debt even harder to pay because interest payments on that debt go up. So they are stuck between a rock and a hard place. And this is why the next Fed meeting on the 16th of June and 17th is so important. That is when Kevin Warsh is going to give his first real statement as chair. That is when we are going to get some clarity on which direction they are leaning. And that is also why I am hosting my live investor workshop on the 16th of June. Because no matter what the Fed decides, some people are going to get wealthier, and I want to help you be one of those people. Now, before I get into specific investment ideas, I want to remind you of something important. The Fed does not make decisions by one person. There are 12 voting members. Kevin Warsh is just one of them. He needs at least 7 votes to make a move. And right now, we have the most divided Fed we have seen in modern history. Some members want to cut rates, some want to keep them steady, some want to raise them, so nothing is guaranteed, but we can prepare for different scenarios. And that is what I want to talk about next. I am not a financial advisor. I am just a regular guy on the internet. Investing involves risk. You are not guaranteed to make money. In fact, you will lose money at some point. So always do your own research and never blindly trust a random person on YouTube. With that out of the way, let me share some ideas that have worked historically in different types of economic environments. First, broad market investing. This is the simplest and most proven approach. If you invest in the stock market for the long term, especially through a broad index fund, you have historically done well, whether the Fed is raising rates or cutting rates. The S&P 500, which tracks the 500 largest companies in the US, has gone up over time. There are funds like VOSU that give you exposure to the S&P 500. I personally own shares of VOSU. Another option is VTI, which gives you exposure to the total US stock market, including thousands of companies. Or if you want something a little more growth-focused, you can look at the NASDAQ 100, which tracks the 100 largest non-financial companies, which today are mostly tech and AI companies. The NASDAQ 100 has historically outperformed the S&P 500, but it is also more volatile. When markets crash, it crashes harder, so just be aware of that. Second, real estate. Real estate has also been a solid long-term performer regardless of what the Fed does. You can buy physical property like a rental house or a commercial building, but I get it, buying real estate is expensive and time-consuming and not for everybody. So if you want exposure without buying a physical property, you can invest in REITs, which are real estate investment trusts. These are companies that own and operate income-producing real estate. They have to follow the 90% rule, which means they have to pay out at least 90% of their taxable income as dividends. So they tend to pay higher dividends than typical stocks. A broad REIT ETF like VNQ can give you exposure to the U.S. real estate market. There are also more specific REITs for single-family homes, apartment buildings, office buildings, and other types of commercial property. Third, speculative investments. These are the ones that tend to do even better when the Fed cuts rates. When interest rates are low, institutions borrow more money and put it into higher risk, higher reward assets. Bitcoin is the most famous example. You can buy actual Bitcoin or you can buy a fund like IBIT that tracks it. I personally prefer buying the actual asset, but the fund option works too. There are also growth funds like VUG that focus on companies with high growth potential, or more speculative funds like ARK, which is run by Cathie Wood. This fund did incredibly well when rates were low, but got hammered when rates went up. That is the nature of speculative investing. Fourth, inflation hedges. If you think inflation is going to keep rising, you might want to look at Treasury inflation-protected securities, or TIPS. These are bonds issued by the government where the interest rate adjusts based on inflation. So if inflation goes up, your payments go up. You can buy TIPS directly from the government or through a fund like CHP. Gold is another classic inflation hedge. When people get scared about the dollar losing value, they often turn to gold. It does not produce income or value, it just sits there. But it has historically held its value during times of uncertainty. The price of gold skyrocketed after 2008 and again after 2020. You can buy physical gold or a fund like GLD. So here's the bottom line. We do not know exactly what the Fed is going to do, but we have 50 years of history showing us patterns. We know that in every major Fed cycle, the average person got poorer while asset owners got richer. We know that when rates are cut, speculative assets tend to boom. And we know that stocks and real estate have performed well over the long term, regardless. So the question is, what are you going to do about it? Are you going to keep your money in a regular checking account earning nothing while inflation eats away at your purchasing power? Or are you going to take control, make a plan, and put your money to work? I am not saying you need to become a day trader or throw your savings into Bitcoin. I am saying you should educate yourself, make intentional decisions, and take action. That is what I did when I was broke in my early 20s. I started small, I started boring, but I started, and that made all the difference. If you got value out of this video, the best way to thank me is to share it with someone you care about, send it to a friend, a family member, or a coworker. Spread this kind of financial education because most people are not getting it anywhere else. And if you want to go deeper, I am hosting my free live investor workshop on the 16th of June at 12 p.m. Eastern. We are going to talk about how the economy is changing and how you can build wealth through those changes. Link is in the description. Peace.